what I want to get across in this quick webinar is to just have an overview of basic tax planning that you need to talk to your professionals in this year and in the upcoming years. What we do is, in our firm, what we do is we have our tax planning module, which we walk through with our clients, and some of these are sent through videos, and we're doing more and more of those going forward, starting July. But some of these I'm going to talk to you about is going to be very high level, and it will not address your own situation. If you are our clients, we obviously will talk to you and get the same things done for you. And we might have already done those things to you, but this is I just want to make sure everyone understands tax planning. It's not it is not different for everyone. It's the exact same thing. You just need to pick and choose which one it fits you the best, which one you're most comfortable with, because tax planning comes with a lot of admin work. All the tracking, recording, contracts, things. You need to know all of those things. If you have a team of admin, you can always help you achieve the tax planning. If not, you can do it yourself, but it always comes with the trade-off. So you need to understand how much tax we're talking about. Is it worth going to all this trouble to save $300 in tax, or should you wait and just focus on bigger tax planning strategies? That's what I want you guys to understand this, okay? Some of these might not save you a lot of taxes, but if you are interested, you can always implement them. So we're going to go through a bunch of these today. When I say bunch of these, the main ones. And if you are connected with us through social media, you will see a lot of these being discussed in much more detail going forward. So make sure, after this, just find us somewhere. Find us in one of the platforms, okay? Facebook, Instagram, LinkedIn, or TikTok, YouTube. I think we're everywhere. Find us one place where you monitor, so you can get into much more detail about these strategies that we can talk about. But today, what I'm going to talk about is we have some presentation prepared. I'm not going to go over that presentation I'm not going to walk you through the presentation. What I'm going to do is I'm actually going to go through as if I'm doing a tax planning for one client, and then you'll see what modules we cover and what you should be asking and thinking in the future and even right now, so you can get the best benefit you could get. That's what we're going to do. So again, if I go too fast, Julie, just let me know, and then we'll go from there. How does it sound, Julie? That sounds good?
Okay, we're so happy to have everyone here. Don't forget, if you have any questions, place it in the webinar chat, and we will address them as the webinar goes.
Perfect. So let me show you one thing. I think I'll share my screen, everyone. You guys should see basically what a tax planning this is how we scope our work, and I think this should help everyone understand generally, what you should think about when you think of tax planning, because most people don't know what tax planning is, and what happens is they don't even know what to ask or what should be covered and all those things. So if you look at my screen, this is our tax planning module. It goes to very detailed. We have 75 tabs here. We are converting this to a software right now. Our team is already working on this. This is probably going to go live by the end of the year. The software, which you can actually go online and do your own tax planning going forward. But right now, before that's happening, we're going to help you do that. So if you look at my screen, this is the basic tax planning that everyone needs to go through. Basic, okay? Because everyone has their own situation and own unique situation, I should say. And you will have to talk to your professional so they can address them. But this is very high level how we scope and price our tax planning. But if you look at this and the basic tax planning, your tax return needs to be reviewed if you're working with someone new. Paycheck projections, are you maximizing your 401k and HSAs? Extension calculations, estimated tax calculations if you have any kind of businesses or side gigs. Withholding, right? Not everyone withholds correctly. So when you go file your taxes, you're going to owe $3,000, $5,000, $10,000. that needs to be checked during tax planning. That's what we do. Everyone needs to do this every year. If you do this every year, you will, maximize your basic tax planning. Then we layer that in with real estate. How big of the property should you be buying? Cost seg analysis, tax savings with and without real estate. How does it affect you? Lending, from lending perspective, from a lot of other things. We go through that. We walk you through your material participation, real estate professional status, short-term rental loophole, like-kind exchanges, 1031st exchanges, a gain on asset. When you sell an asset, how much gain you're going to pay, how to avoid that, those kind of things. We go through that. About entity structuring, how should you be structured as whatever business you run, as a small business, right? A lot of things you need to understand. How should you be running? Do you need to have specific kind of entity structure to make this happen? And we walk you through that. In our tax planning, we tell you, okay, which one is best for you, which one saves you the most tax, how to plan for that. We walk you through that on our tax planning. And then we talk about your retirement plan comparison, right? If you have a Schedule C or your partnership, S corporations, even at the individual level, what you should be focusing to save taxes. We go through all of that retirement plan. And then also we calculate that for you. We actually give you the number. Okay? We give you the number, how much you can contribute to maximize your tax savings. And then S corporation, is the S corporation best for you? We walk you through the cost benefit analysis, QBI optimization, paying your spouses. Remember, paying your spouse really helps you. And I'll go through all of these in actual numbers if I can over the next hour or so. But I'm just trying to tell you what you should be thinking. Paying your spouse, paying your children, distribution versus salary. People don't understand. Should I be taking salary or should I be taking distribution? How does that affect your taxation? Can you reclassify this later on? We go through all of that. The other one is the individual level. Tax savings at the individual level. What kind of tax savings can you do? Because remember, you pay taxes at the individual level, but a lot of other things we talked about before happens at the business level, at the entity structure level. But can you do the same thing at the individual level? We walk you through a few things you can do. Same thing with the business. We walk you through what kind of deductions you can take, how much it can save you taxes. We walk you through that. Again, other normal tax planning, buying an auto, hiring your kids, buying out a business, all those things. Okay, we walk you through all of that, and then we give you, and then this is our we answer questions for you. We answer your notices and stuff if you're engaged in tax planning. But that's what the tax planning is. So now I'm going to go through all of this today, but I wanted to give you this basic understanding of what the tax planning is. Now, if you come to and talk to me, Ashish, I'm going to start another partnership with my friend. How should I be structured? Then see, that's what the entity structuring is, right? I will walk you through this. Obviously, if you work with us, you will come to talk to us. Me or my managers, and you're going to say, I'm going to start a business. Can you walk me through this again? And we will walk you through that. So, it's very overwhelming the first time you go through these, and then every year it gets better and better, better and better. And, once, I think in end of 2 years, you're so knowledgeable that you can actually, your next 10 years of your life, all the knowledge you just learned, you reap the benefits. Meaning, what do you do when you do tax planning, and whoever you pay this, okay, it doesn't matter who you work with, if they do this, it's not for 1 year engagement. If you pay $5,000, that's $500 for next 10 years, because you're basically paying $500 for tax planning for the next 10 years, because all the knowledge you gather you're just not going to use for 1 year. You need to understand that. So your return on investment, you don't just look at 1 year, you look at 10 years, 15 years, even 30 years. I have some clients, when we went through the entity structuring with them, and then they sold their investments to other, like when you're trying to collect the fund and investors and third-party partners, they sounded so knowledgeable that they could buy more deals, close more deals, and whatever they paid us came to them thousands fold. Thousands, I'm talking about thousands fold. There's no other investment that can do that for you. So all that to say is, understand what tax planning is, and this is what the tax planning I'm talking about. Is this comprehensive? Everything is here? No, it is almost impossible to put everything that applies to everyone in this. I just wanted to jot down this here, so it's basically most of the small businesses face this issue, and that's what we're talking about. Now, I'm going to what I'm going to do next is basically in this module, I'm going to talk about how can you use this kind of tax planning services to benefit you, and what you should be expecting. Okay, it's going to give you strategies and everything, but it's not going to apply to you. You do need to work with your own CPAs and your team of advisors to run your own numbers, right? Like our clients do for us. But it's going to walk you through the concept so you can actually think about it yourself, or you can work with other investors. That's what we're going to do next. Okay, I'm going to share my screen again, and then we'll go through the basic understanding of tax planning. So let's assume what happens is you're a client. You come to us, and you tell us, hey, I'm married. I'm just gonna put my name. Okay, my name, my spouse name. Let's say you live in Colorado, and you have 2 kids. Let's say, or 0 kids. You have no kids. Just to make it simple, you're married. This is your age. You're 50, and I'd say you're 49 and 45. Okay, and then you come and tell me you make $500,000 in your W-2. You make $500,000 as a taxpayer, and your spouse maybe she doesn't make any money. Okay, this is she's a housewife and she doesn't make any money. She's not into any retirement accounts. You are. So you just, again, very basic stuff, right? It's not complicated. This is what you need to tell your CPAs. Again, they need to have a system like this so they can run the numbers for you. Not everyone has one. That's why we're changing this to a software right now, and it's gonna get huge once this launches. Okay, we're gonna sell this for other firms so they can provide the same benefit that we do. But let's say you come to us and say that, and nothing. There's no other income as a W-2. This is a W-2 employee. Now we're talking about business owner, right? You need to have some kind of business associated with you. Let's see how that affects you. You can be an S-Corp, Schedule C, partnership, but I'm just gonna focus. Let's focus this first on. Let's see how this affects your tax. This is the first thing I want you guys to take away from this is, do you need an S corporation? A lot of people go through that calculation. I can tell you very, very simply what is the number we're looking at. At what point should you be an S corporation? I'll give you that number, and that's going to really help you determine, okay, should I be an S corporation or not? Let's say you make $500,000 as a taxpayer, and your spouse wants to run some kind of business, and she opens a saloon, or it doesn't really matter. Okay, it can be any kind of service-based business, and she makes let's say $80,000 after all the expenses that year. Starting slow. Let's say after all, she makes $80,000. I want you to look at one thing. When I go and try to calculate your taxes, I know, guys, this looks complicated. A lot of information here. If you are our client, we give you this file after our tax planning is done. But I just want to say, because this gets overwhelming, I understand. But right now, I just want you to focus on a few things. Give me here. So let's say you come to me and say, okay, now your spouse makes $80,000 of net income, or $100,000. Let's say you make $100,000 net income from running your own business. Should you be an S corporation or not is what we need to discuss, right? Look at this, $100,000. Do you see this $14,000 of self-employment tax? That's what we're trying to avoid with the right kind of entity structuring. Right now, you're paying $14,000 more in taxes, self-employment tax, because your spouse made that $100,000. So first point, this is one of the biggest things most of the small businesses miss. And even if they have S corporation, they don't know how to handle the payroll, so they miss the entire thing anyway. This is what you should think about. If you're making $100,000, let's say, you should do something called S-Corp analysis, how to optimize everything. This is what I meant when I was showing S-Corp the planning module, this S-Corp analysis. This is what I'm talking about. Okay, first thing you need to understand what's going on. Your spouse makes $100,000. I want you to look at this. What is the tax savings with and without S corporation? If your spouse were to make $100,000, and let's say we pay her $15,000 salary, again, we'll optimize that later on. Look at what happens. Give me a second here. So spouse, married, finally, jointly. This makes sense. The old module, but I want to look at this. So what happens when you go file taxes? You need to compare. Okay, how much the S corp? How much are you making to make the S corp beneficial? So I'm going to move this from Schedule C to an S corporation. Let's say I'm showing you how does that impact your tax savings? When I'm done with finishing and with the numbers, you should know, hey, this is my tax savings. If you look at my screen, I know there's a lot of numbers there. You see this? It's at $20,000 with retirement accounts, without retirement accounts. Even without retirement account, your tax savings is $14,000 just because you had an S corporation. That's money in your pocket. Otherwise you would have paid this to the government just because you file an S-Corp return. So what's the cost of filing an S-Corp return? You have to file a separate tax return. You have to run a payroll. Those are two things. Now we need to, then your CPA or your tax advisor will optimize your payroll. People think paying less amount of salary is the best way to save taxes. Just look at this $14,000 number. I know it's very small, but you can rewatch this later on. If I just increase this to $20,000, your tax savings goes up. If you do $25,000, your tax savings actually goes up. If you do $30,000, your tax savings goes up. Down, if you see down here, 26. What I'm trying to tell you is just paying the lowest amount of salary is not a right approach for you guys. Okay, just understand that when you're doing the S-Corp analysis. Again, your CPA needs to run your numbers. This is basically for this made-up client, right? You might not have same kind of income or stuff, but you do need to understand you have to really focus on payroll optimization, which is that what I'm talking about, and then how much of a 401k you need to contribute with and without retirement account. All of those needs to be factored in. And on top of that, here, let me show you this one more thing. What happens if you pay your spouse? If you, rather than paying, and this gets complicated, but rather than paying yourself your spouse's salary, if you pay you, which you are already over the FICA limit, then you can save more taxes versus paying your spouse. I know it might be confusing, so I'm not going to really go over a lot of those stuff. What I'm trying to tell you is think about what happens if you pay your spouse, not just you, because your spouse is already over the FICA limit. She's already paying the self-employment tax. So whatever payroll you pay her, she's saving that 15% in self-employment tax, and you run your payroll less. And the reasonable salary is combination of the officer's compensation in S corporation. You and your spouse can be an officer of the company if you organize your S corp in the right way. So this is one of the big things. This is one of the big things that I want you guys to focus on first. S corp analysis, how to save taxes in S corporation. With that being said, I just talked about tax savings from an S corporation. Now, what you could do at the S corp level, like actual business deduction, is something you need to understand. Let's say you have a service-based business and you have an S corporation. This basically walks you through, okay, what happens, how much tax you can save by running all of these strategies. I'm going to go over this very quickly. I want you to understand this. It says, hey, rent your home to an S corporation. Remember, this is not a home office. This is not Augusta rule. We're talking about if you have a garage or if you have a separate room, you store all your materials, all your inventory, you need to pay yourself a rent. If you pay yourself $500, like $600 rent for that one room, the amount of tax savings you can save, FICA and income, is almost $1,300. Again, don't get hung up on the numbers, okay? This is not even your number. I'm just trying to give you a very quick understanding of, in this tax bracket, which we just saw, and remember, this factors in your FICA and everything. This is extremely detailed. If I try to explain this to you, it's not going to make sense to you guys. Ignore that. Because FICA tax savings happens at a different level. Once you hit that $160,000, your savings goes to 20%, at 2%. So this factors everything. This is not just random numbers your tax advisor is putting together saying, well, you're going to say 15% on everything. You don't say 15%. That's why you need to factor in the lower percentage. And that's exactly what this does. But anyway, what I'm trying to tell you is, what happens if you rent your house to an S corporation? Boom. Let's say you charge $597 every month, and you get some deductions. That's almost, again, right down here, $1,300 tax savings. What happens if you do a home office reimbursement? The $13,000 home office reimbursement can save this both almost $4,000 in taxes. $5,000 because of it says income tax and it also says FICA tax. This one doesn't say income tax because you still have to pick up the income. It factors all of those. What about Augusta rule? I don't know if everyone knows about Augusta rule, but if you rent your home to your own corporation, less than 14 days for a business event that you and your employees, or you and your spouse, other employees, you gathered, and then you can pay yourself $500 14 times and not even pick anything as an income. How much that can save you? that is, almost $2,300, right? This is that's the FICA tax savings and income tax savings. Same thing with, I'm not going to go over the fringe benefits right now. It gets a little more complicated. A lot of other things needs to come into play. Don't miss out on expenses, basic expenses. I mean, supplies, startup costs, travels, education costs, professional fees, cell phones, legal fees, gifts sometimes. And some of these things, people tend to miss this. And when they run a small business, don't miss this, because even if you gather all of this, it's not even that high, and it's a $100, that's another $3,000, almost $4,000 tax savings, right? So just make sure you understand, don't miss out on the basic expenses. You can Google this. I don't have to give this to you. Make sure the expenses are ordinary and necessary for your business, and you should be fine. But that's what I'm talking about. And let me see. Now, other is employing kids. This is a good one, right? Let's say you have a kid. Again, this is how our tax planning software works, guys. I'm just going to give you an overview. Let's say you tell me I have 3 kids. I'm going to put the number 3 here, and then you go to your tax savings calculation. At the S-Corp reduction, 3 kids, you can literally pay them $61,000 from your business, save 70 grand in taxes without any tax implications if you do it correctly. So you need to know these numbers before you can make your decisions, right? So I'm not saying this is the maximum you can pay. You don't have to pay that much. You can pay them $10,000. Still have some tax savings. So understand this concept. You need to, and we give you action items and stuff, but understand this. If you need to issue 1099s versus W-2, we walk you through that too. We tell you exactly which method is more. What is the cost of running 1099 versus W-2? How much can you pay? All of those things we give you much more detail, but you need to understand the concept. Hey, this can be done. This is how much I can save, or at least someone needs to calculate these numbers for me so I can make my decision. Is what the tax planning is. Okay, and employing your kids. The other one is health saving accounts. As a business owner, if you can pay yourself in health saving accounts, you can save another amount. Health insurance, you can, again, remember, you can, as an owner, you can deduct the health insurance you pay for your family. Even you're the owner, you can pay for the entire family and save health income tax savings if you have health insurance. Retirement plan. This lady here, who this spouse, she could, if with the S corporation, she could have saved $6,000 by contributing that by contributing some retirement, $14,000 in retirement, her own retirement account. So that's a $6,000 tax savings. Think about the return, guys. And I'm a numbers guy. If you were to save $6,000 on $14,000 contribution, that's 44% return on your investment. What kind of investment does that to you? If you buy a stock, do you think that stock is going to give you 43% dividend, or is going to grow 43% in 1 year? No. This is strictly from tax savings. We're not even talking about that 14 grand doubling next year. We're talking about strictly tax savings return. Okay, think about those kind of things before making your tax saving deduction. And so obviously we have an auto purchase. If you buy SUVs and stuff, and you can deduct the whole thing, so you can save you $13,000. Again, guys, I know it's a lot of information here, but look at this. If you were to do all of those strategies in your tax bracket, even at the marginal tax bracket, we're talking about $56,000 tax saving. At the effective tax rate, we're talking about $43,000 tax, right? If you were to do everything. So that's why I said effective, because your tax income goes down. So all I'm trying to tell you is understand these numbers before making decisions. If someone just tells you in TikTok, because it happens a lot nowadays, right? You say, hey, do this, hire kids. You need to understand how much can you save, because you're not going to do everything, because not everything can give you the same tax benefit, especially when you understand the FICA and other limitations, because you need to have a system where it calculates, okay, how much you're already over the threshold. Because you see it says net saving tax rate is 10%. It's not what you think it is. Because you're even though you're in 39% tax bracket, your net tax saving might be at 10%. So those things needs to be factored in. So just to recap what I just said, I talked about 2 things, right? As a business owner, what you need to focus on are 2 things. First of all, have the right kind of entity structure for your business, and there's a threshold. If you make less than 50 grand, it might not be beneficial to be an S corporation. But if you were going to do this, if you were, if you know you're going to make this much income this year, you can retroactively get an S corporation, do everything we just talked about, and save, not only on the payroll tax, also all the deductions we talked about. We can do all of that. So that's one big thing I want everyone to understand. I know it's a lot of information, guys, but I'm not going to go over all the small stuff. It doesn't really make a difference. I think this is the big takeaway. That's the first thing. I'm going to talk about the second thing, and I'm going to bring in real estate. because we focus on real estate, and I will show you how it helps everyone. But hopefully everyone understands the first step is to understand how to optimize your payroll, your entity structuring, all the deductions you can take, hiring your kids, insurance, everything, basic stuff. Do that to lower your operational expense. Now, before I move into real estate, I want everyone to understand as a small business owner, your goal is to not show negative income. If you do that, you're not going to get the loans. You're not going to get approved for real estate purchases. Your DTI is going to get, you're not going to buy a new car. It's going to hurt you. Your goal is to show income in your business and use other avenues, which I'm going to show you next, to offset your income so it does not affect your DTI, debt to income ratio. When you go to for lenders to approve for your loan, what's going to happen is they're going to look at your hey, what's going on with my what's going on with your business? You're losing money. Why should I give you loans? They're going to tell you that. Do not be one of those. And I have so many clients who comes to me and say, I need to amend my tax return because I do not qualify for the loans. Because I try to write off everything. Don't write off everything. You need to understand your future and your goals. If your future is to sell your property in the next few years, you need to show as much income as possible. Have other avenues to save taxes. We'll show you that next. But your business should be producing NOI, because how does a business get evaluated? NOI and cap rate. That's how it works. Okay. Again, I'm not going to go there, but you need to have an income so you can sell it for millions of dollars. If you show losses every single year, no one's going to buy a business. They're going to buy at a discount. Okay. So understand that. So why am I saying this? Is operationally, yes, we want to do everything we could possibly do to save taxes, but don't try to go negative every single year, or understand your goals. If you're not going to sell your business for the next few years, if you don't have any loan needs, then yeah, you can be aggressive. That's fine. But understand your goals for the next few years before making tax deductions decisions. Okay. Don't just try to save only taxes and get hurt at the end. That's the first thing. Second thing is, now I just told you, hey, yeah, let's have $1 million of revenue from a business, let's say, but how can you still pay zero taxes? That's what I'm going to show you next. And then that's what we're going to talk about next. So I'm going to slow down. I'm going to stop. See if I don't see any questions. I guess that's a good thing. I'm going to jump off into the another area of tax savings, and I'll tell you why this is so important for every business owner to understand. And I'm going to do that. But I'm going to stop. I'm going to slow down. Julie, is there anything I need to know before I move on to the real estate?
We have lots of questions during the call, which I appreciate everybody asking. Thank you so much. We have one from Samir. He was looking for a one-stop shop software like this. So once he puts in all the details, does it give him compliant documents to be filled out at the end, like filing documents and payroll? I just wanted to express again kind of what tax planning is with this software versus what we can offer if you do join with us.
Samir, he's thinking ahead, and this is exactly why I'm working with my tax software development team right now. When we are building this, we are gonna integrate. So if, let's say, because one of the tax modules gives you your estimated tax payments, what it's gonna do when the software is live is it's gonna spit out the estimated tax vouchers. It's gonna give you everything in there, and you can just print it out or use that to do your estimated tax payments. But it's not gonna file for you. Okay, we're not trying to be a tax software company, because there are hundreds of them. What's lacking in the industry is tax planning, and this is just a start, guys. I'm adding 80 more detailed strategies on our tax planning modules in this year. By the time it gets live, this is going to be life-changing software for so many end users, not the firms. Okay, firms already has their tax planning softwares, which doesn't do anything. I'll be honest with you, because it's not good. That's why I'm creating my own. But this one, when you Google and say, okay, I want to save, okay, this is my how to save taxes. This pops up, and you put your income, your K1 income, your children, how old you are, basic information. If you want to do quick calculation, or detail, if you want to put your K1 in there, it tells you exactly, okay, based on this information, AI is going to get integrated there. This is what you could do. And then eventually it will give you some forms to fill out. Hey, this is what you should do for 401k. This is how much salary you should be paying yourself, all those things. But it's not going to file your taxes or do compliance for you. I can tell you that. You need to then maybe work with us or someone else you work with to do the compliance.
And can individuals that are just shopping on Google purchase this when we have it ready, or is it just specific for firms? Like, will
individuals, so end users, taxpayers like me and you make $500,000 this year, and you don't want to pay because we do charge $10,000 for this tax planning we're talking about. Okay, And again, very general number. Sometimes it's lower and higher depending on the situation. But now you can go online, put your numbers in. It's going to give you tax savings, and you can pay $500 to get your report. It tells you exactly how to do it, implement it. But it's going to happen by the end of the year. So we'll hopefully. I mean, you know how the projects are, but my team is working day and night to make it happen.
Yes, and I think that might be the rest of the questions.
Okay. I know it was not related to the taxes, but it gives an idea, and this is happening, and everyone can benefit, obviously. So that's the first thing. Second thing is, again, you guys know we specialize in real estate. Real estate is extremely complicated area of tax, guys. Most people cannot, most of the CPAs struggle with this. We get tax return with everything's wrong, and we have to fix everything for the last 3 years if we can fix. So if you have real estate, always make sure you work with someone who understands real estate. I just want to give you this and advice because you're going to end up losing more money to amend your tax return and lose basis on your properties when you sell the property. That's going to happen. It happens every single day. Unfortunate. Literally, I had this lady call me not yesterday, but I don't know when, but she was crying because she had to pay $392,000 extra in tax just because she has a wrong entity for real estate. Like, remember, I just want to tell you one thing. If you are a rental real estate owner, getting a right entity, like legal structure, will not save you any taxes. I'm not going to lie. Getting a real estate itself would save you millions of dollars in taxes if possible. But getting a right LLC structure for rental real estate will not save you any taxes. However, if you get a wrong entity, it will cost you money. Doing it right doesn't save you taxes. Doing it wrong costs you money. I want everyone to understand this if you guys didn't know about it, because people will try to sell you saying, "Oh, I can save you taxes with LLCs." Doesn't happen. Okay, don't believe on those gimmicks. But so what next? What next is I just told we just did the planning where you made $100,000, your spouse made $500,000, and you're saving taxes through this small strategy at the business level, your 401ks, hiring your kids, all those are fine, but you're still paying a lot of taxes. How can you wipe out your taxes? What I'm talking about, guys. That's what I'm talking about. So let's focus on the next step. I think we have 25 minutes left. I will probably talk about for next 10 minutes or 15 minutes, and we'll stop and we'll let you guys ask questions. Okay, but that's what we're gonna do next. And this is nothing new. If you are clients, we do this for you guys. And if you're not our clients, if you schedule a call with Julie, she can walk you through this. She's not gonna run your numbers. She's basically gonna do the same thing. But we can do this for you. Okay. So anyway, so let's talk about this is what I'm trying to tell you earlier. Let's say this is your taxpayer. Okay, you make $500,000. You live in Colorado, and your spouse makes $100,000. Schedule C. Everything is fine. And when you go file your taxes, this is what's going to happen. Very high level number here. Okay, don't get too attached with this. You're going to pay around $156,000 in taxes. That's your tax. That's the tax amount. And you might have already paid $145,000 through your withholding, because that's normally you pay in your W-2. When you go file taxes, you're going to get paid $12,000. But what people don't understand is this. I want to show you one thing. Let's say I already withheld enough to not pay any taxes. Meaning, when I go and say I have withheld $120,000 already, and federal and $45,000 already from my paycheck, because that's what happens. Your employer will withhold your taxes, so when you go file your taxes, you don't have to owe anything. When that happens, just look at this. I owe $56,000. I've already withheld $165,000. So when I go file taxes, I'm getting $8,000 refund, and everyone is happy. Oh, you know what? I didn't pay any taxes this season. I got a refund back. That's not true. You paid $156,000 on taxes. You just happen to already prepay the most of it, and you got the what you paid. You basically gave a free loan to the government, and you're happy about it. It's just one of the. I would rather you owe government and pay some penalties because it's cheap money versus giving money to the government and getting a refund at the end. So I want everyone to understand that. But let's ignore that as well. Let's talk about what is our goal. Our goal is to not remove this, address this $8,000 of refund or what you owe to the government. Our goal is to, how can I wipe out this $156,000 of entire taxes as tax planning, right? Is it going to happen for everyone? Probably not everyone. Okay, it really depends on your goals. How if you really want to do this. So, and why real estate? And people ask me this a lot. Why do I focus on real estate? Why do I invest in real estate? Here's the reason, guys. I just told you earlier, and I'm going to share my stuff. Maybe I hope everyone understands this. Why real estate is this is the reason why real estate. You go and you buy, you open up a restaurant, and then you lose $100,000 every single year for the rest of the next 10 years. Yeah, that $100,000 loss can offset your W2 income and you can save taxes. But you're losing $100,000 cash every single year for next 10 years. That's $1 million you lost. You're not going to save $1 million tax. You're probably going to save $300,000 tax. That's why real estate comes into play. That's why all the rich people invest in real estate. That's why the law is favorable because all the rich people are in Congress, right? They do the exact same thing what we're talking about. We have laws in place that helps you save taxes without losing any money, unlike restaurants or any other business. Doesn't really matter. Okay, I'm not picking on restaurant business. Any other business, if you were to invest in real estate, manage them correctly, then it can actually save you taxes without losing money. And that's what we're going to focus on next. Might look complicated, but I just want you to understand this very simply. If you look at this, a lot of information here, but I just focus on a few things. I just told you earlier, hey guys, so if this was an actual taxpayer, if you see that after all the deductions and everything, the taxable income is around it's a 542. Okay, so our goal is to, what is our goal? Our goal is to, how can I get this $542,000 down to zero? This 25, this number to zero, so you're not paying any taxes. That's the end goal of our conversation, is that how can I get my taxable income to zero to pay zero taxes? And when I say get down to zero, guys, remember, this does not affect your DTI. That's another big thing. If you just get this down to zero by losing $500,000 in your restaurant business, you're never going to qualify for the loans. However, if you do what I'm saying right now, it does not affect your DTI. You're equally lendable, even though you pay zero taxes. How does that happen? Real estate. I know most of you already know this, but I just want to give you a very high level example here. 2024, let's say this year, 2024, if a bonus depreciation, okay, this is a bonus depreciation, comes back to 100%.
Please, are you showing your screen?
Oh, I'm sorry.
Okay.
Okay. What I'm saying is our goal is to take our taxable income down to zero. It needs this. So this $552,000 needs to go down to zero. That's our goal. Same thing with the state. Okay, we need to go down. This needs to go down to zero so we can save entire $154,000 in taxes. How can that happen? Okay, don't get hung up on numbers and stuff. Okay, just understand the concept here. If 2022, if bonus depreciation is one of the depreciation, it comes back. This is how lawmakers, is trying to make their own money. Okay, this is, again, when Trump got elected, he got the 100% bonus depreciation back. It was always at 50%, because remember, what does Trump do? He's in real estate. Simple as that. Okay, he signed a law to save millions of dollars in taxes when he was in power. Not a bad thing. I saved many money because of that, so I'm not complaining. So that's how election years are so important. Right now, there's a talk to bring it back, because if the law doesn't come back, it's at 60%. And I'll tell you how this affects your tax planning. But let's say it comes back at 22, at 100%. For this taxpayer to save maximum amount of taxes, this is the number right here, 2.16 million. So if I were to go and buy one commercial property for one, or a short-term rental, or 5 different long-term rentals, hold on. Again, don't get hung up on the numbers here. Okay, I just want to show you one thing. You see this? I'm completely wiping out of my taxes. Taxable income, zero, because of this property at 25% cost segregation, at 100% bonus depreciation. Meaning, after 154, I'm getting everything as tax savings. I'm paying zero taxes. Meaning, when I go file taxes, rather than getting $8,000 back, I'm getting $165,000 back, because that's what I paid to the government already. I'm getting that back.
Ashish, is there any implications for different states that allow certain percentages?
Absolutely. So Colorado is one of the good states. Like, it allows bonus depreciation. If I change this to, let's say, if I change this to Georgia, so let's see how it changes. So now your tax savings, rather than $154,000, right? It's going to, out of 161, because remember tax rate change is 134. It's still a significant, because this is what happened. Federal is always the same, but now state, you can only offset 79 versus entire amount, meaning you're saving only $3,000, almost $4,000 on tax out of 30. So total, you're saving around $3,400, 134. So when you go file taxes now, that's 137 because you do owe something to Georgia. Okay, you're going to owe $27,000 to Georgia. You made $45,000 payment already. You're going to get $17,000 refund. So so what I want you guys to understand is I know this is very high level and it's very fast. I do understand, but what's the concept? What's the concept here? Concept is you made all this money and you're paying $154,000 to government. Is there a way for you guys to plan your investment correctly, get into the same wagon as most of the wealthy people to save taxes? Because again, Trump, Biden, doesn't matter who your lawmakers are, they don't have a separate tax code. This is what they're doing. And why can't you do it? Why can't you use the resources that's available to you? I know not everyone's going to have this resource. They need to work with someone like us. Doesn't have to be me. Okay, anyone you can think of, you can work with. Anyone you can think of who does tax planning for you, work with them to make sure this works for you. Because that's all I'm trying to do. These are what I shared today is entity structuring and real estate. Combining both of them is the biggest tax savings you're going to get. Are there other methods to save taxes? Let me tell you. I'll be very blunt with you, okay? Because I've seen a lot of this advertisement online and all those things saying literally there's only 5 ways to wipe out your income, like we're talking about. That thing we just talked about, entity structuring was one of the good way to save a lot of taxes. That's the first thing. Second is real estate. There's nothing works better than real estate. I just showed you that. Obviously, there are a lot of back rules you got to follow. Okay, rep status, short-term rental, material participation. It doesn't happen if you buy real estate. You have to follow all the rules, obviously, but not going there, right? I'm just giving you a method, right? So let's say you do what I said, you save taxes there. What happens? What are the three? There are 3 more things you can do to do the exact same benefit as real estate. First is oil and gas. If you invest in oil and gas fund, you can do something like that, something like real estate, but it's very risky. You put $200,000 on oil and gas, that money might not even come back. If you put $200,000 in your investment property, you're going to buy as a rental, the $200,000 might be $1 million in 10 years. The $200,000 oil and gas, even if they give you back, they'll give you like 5-6% IRR. So money, you save taxes, but there's no as much appreciation potential as real estate. But you can do that with oil and gas, but very risky. Okay, 1 in 3 is a scam or something, from what I heard. Second is something called easements. Everyone gets audited if you invest in easements. It's called conservation easements. If you Google this, you'll know that people who have lost their hair because of easements. That's another way you can do it. I just want to tell you that those are there are other things like deferred compensation. If you have big businesses, you have captive insurances. I'm not going to go there. We're talking about small businesses. We're not talking about multi-million-dollar businesses right now. So what I just showed you is one of the biggest and brightest way to save taxes legally and with having a good advisor on your team. That's what I was trying to show today. So with that being said, I'll stop. I know I said a lot of things. We have maybe 15 minutes. I saw some questions here. I'll just if I can, I will answer them. So Samir, we answer Samir. I share my screen. Sorry for that. So someone asks, do you set up real estate LLC for the benefit? So even if I live in Oregon, can I get benefit if I purchase a property in Colorado? So the question is this. Let me repeat. I know I just mumbled here. Do you set up a real estate LLC for this benefit? So even if I live in Oregon, can I benefit if I purchase a property in Colorado? That was the question. Basically, the question is, can LLC benefit me? And I answered this earlier. LLC has no tax savings for rental real estate. If you're going to start flipping, if you're going to start doing development, wholesaling, restaurant, drive an Uber, OnlyFans, you never know, you will make a lot of money. And then you can have an LLC to save taxes. It has to have right kind of elections, but which state does not matter. What's the reason for LLC? Legal protection. You got to work with attorney to figure out which state is best for you. But I can tell you, based on my not a legal advice, if you're going to provide a service in Denver, so let's say in Oregon, you need to have an LLC registered in Oregon. Because if you're selling something in Oregon and you have an LLC in Colorado and someone sues you in Oregon, you're screwed. The Colorado LLC does nothing to you, right? But if you have a problem, if you live in Oregon and you have property in Colorado, then you need and all the operation happens in Colorado, then yeah, get an LLC in Colorado, register it there, and have all the operation there because that property has nothing to do with Oregon. Even though this has nothing to do with taxes, this is a strictly legal and operational issue. That's the first.
So should individuals that are interested in looking at real estate across multiple states, should they set up LLCs in each state that they're purchasing that property?
From tax perspective, does not matter. Legally, probably talk to an advisor. And I'll show you one structure after we answer this question, how you should think about your entity structuring next, okay? So next question I have here is, do you have to have a reps? Reps basically means real estate professional status designation to be able to offset the cost segregation or loss against W-2. Yes and no, and I'll walk you through that answer in the next few minutes. I think, and the last question we have, what do commercial property mean? I just said it. So the question I have is, what do commercial property mean? I recently set up an holding LLC and loan my personal crypto fund to the company. The idea is to liquidate the fund this year and then invest those funds into a new real estate upper fixer owned by this LLC. Where do I stand in Tommy strategies? You don't want to do that. You want to talk to your advisor before doing all of this. It gets a little more complicated. If there's crypto involved and you're selling it, there's a lot of taxation there. But I'll tell you exactly what I mean by commercial property. Commercial property is two kinds of properties. One is residential rental, like apartment, single family house you rent out to residents, and then one's commercial, like warehouses, malls, retail stores. Those are commercial property. Both real estate gives you same tax benefit. Don't get me wrong. You can buy anything, it gives same taxes. The earlier example was I just happened to mention a commercial property. And the holding company, all of this doesn't matter for you. Is there a way to minimize your taxes with that? What you're doing there? Yeah, there is. You're gonna have to work with someone else who understands this. Okay, but I wanna answer I did not want you to get into this detail about rep status and can you offset your W-2, but if there's no other questions, I'm going to show two things: LLC structure and talk about this rep status and how it affects you. Unless there's any other questions, which I don't see, so I'm going to jump to that.
And then Ashish, could you just end the call whenever we get there about what your favorite tax strategy is?
And my favorite tax strategy is to not file taxes, not paying taxes. Just kidding. I cannot be saying that. I mean, the IRS is going to come hunt me if I say that. Favorite tax strategy, I can tell you. I can literally. That's why I got into real estate. Real estate is one of the only ways you can save taxes while building your long-term wealth, your future. And these were. I kid you not when I say this, guys. This is how real estate affects your life. You're not only going to build your long-term wealth, you're also going to save your taxes. We have clients who have saved $100,000 a year in taxes. In 10 years, that's $1 million. That's a retirement account. People don't even have $1 million in retirement account sometimes when they retire. We're getting that in the next 10 years just by saving in taxes, which you're going to lose anyway. That's the first thing. That's why I told you. So do you be paying $10,000 someone to do your tax planning? $10,000 with the strategy you're learning, you're getting $10 million back. It's no brainer. Either way, not going to go there. This is how real estate works. You buy a property, you save taxes, and then you buy property in your kid's name. Let's say you buy a property in your kid's name and you have them manage it. The cash flow, they become more dependent or more ethic work. If the work ethic increases, you can designate the property for one kid saying, this is your college fund. Manage this property, go do loan bookkeeping, go to organize receipts. Even you have property manager in a different state, give them ownership, kind of sense of ownership, so they take it over, and it changes them. It changes being responsible. It changes them to understand how the returns business works. Life. I've followed some clients for 10 years, and then the kids who were 6-7 years old when they started this is about to go to college, and they have this property which has appreciated almost $700,000-800,000. Their college is funded with that property. So when people ask me, should I be opening up 529 plans and put $1,000 there to save $100 in state taxes? Would you put $5,000 in 529 plans or buy your property in your name? Not only save your taxes, but have an appreciation of $700,000 in the future. Again, talk to an advisor who understands real estate and how it can impact your life, and you should be fine. But not to get distracted, let me answer the question about that rep status. Okay. So do you need rep status? Rep status basically means, do you need that just to save taxes? So if you have a good tax team, they will answer. Okay, look at this. We just don't do this, guys. We do this day in, day out. we have extremely complicated modules. Like I said, we walk you through this because these are complicated. These are extremely complicated topics, and we need to understand how to structure your rep status, how to group your properties, grouping, and how can you save taxes. That's what we walk through. That's why you got to work with someone who understands this. But to answer that question, though, let me talk to you about this. We just talked about earlier, hey, how this property can save you $154,000. How can you do that? Do you need rep status? This is the answer everyone's looking for. There are 3 ways. The losses that you generate in real estate, you can use them 3 ways. There's no other way. First way is if you make less than $150,000. If you make less than $150,000 in your income, you can offset up to $25,000 of W2 income. It's not you cannot offset everything, but that's still the highest tax bracket at $150,000. It's a good amount of tax savings. That's one way you can save taxes. Second way is if you make less than 150, then you have to have a rep status. How to get rep status is another topic. It's complicated. Talk to your advisor, right? If you cannot get rep status, then you need to buy a short-term rental. It's very popular nowadays. I think if we have 2 or 3 more years when you can do this before IRS closes this loophole. So please talk to your advisor if you can do any of these 3 strategies to benefit from what I'm talking about. So these are 3 ways you can use without being rep status. But having rep status does not limit to one class of asset. Meaning, if you were to buy a real estate, and if you want to save taxes, you can buy apartment building, you can buy RV parks, you can buy mobile home parks, you can buy storage units, multifamily. Doesn't really matter. There's so many real estate you can do. Everything saves you taxes if you are a rep, real estate professional status. It's not a licensing. This is not because you have a real estate agent license. That's not what I'm talking about. It's a tax designation. But if you don't have reps, you're limited to one class of asset under short-term rental, which is basically you have to have a short-term rental, Airbnb, Verbo, vacation homes, most a single-family house, right? You're limited. So understand that. But I didn't want you to go into this topic, but you have to think one step ahead. Can your long-term rental help you save taxes even though you're not reps? Should you be doing cost segregation on your long-term rentals even though it's not? Yes, you should if your goal is to have more passive income in the future, because rep status converts your passive long-term losses into non-passive. But if you don't have a rep status, it's always passive. But if you have a goals to make your business income passive, let's say you have an S-Corp, you have a restaurant and you're trying to retire, or you're going to buy short-term rental and you want to outsource completely to property management, you can have other sorts of passive income. Then yes, even a long-term rental can save a significant amount of taxes, even though you don't have reps. You need to talk to your advisor about your goals and what you see in the future, okay? I don't want to go there because it gets complicated and people are going to hit me. I don't want to say any more questions here, guys. I mean, you're almost done with our time. I really appreciate everyone joining in. We have, 50 people listening to us. So this is great. Thank you for your time. I say this, and I've said this before too. If you're new, if you haven't worked with us before, just email us and info@investorfriendlycpa. We try to answer questions in general. Okay? If it's not very too detailed, we have to run numbers. We just give you answers without even getting engaged. If you want to work with us, obviously there's a link on our website. You have to fill out the form, and you can talk to Julie, and we'll go through all this process together. But again, always reach out to us. We're more than happy to help. If you don't want to work with us, follow us on social media. We share all of these strategies in much more detail. We'll do even more going in the future about all these strategies. So let's focus on share this. Just follow us in one platform, which will be fine. Now, all that being said, if you guys have any questions, again, reach out. I see some questions. Thank you. Well, I'm going to answer this one more thing. I have one property on Pat's Place that's 31-day minimum, and 2 properties short-term rental. Do I need rep status to? Depends how your agreement goes with Pad Split. What happens with Pad Split takes the entire gives you a master lease on your property as a 1-year asset, and they do their own thing. That's a long-term asset for you. It's not a short-term rental. But if you're directly renting out to Pad Split of 7 days on average, and you're doing a short-term rental, then it counts as short-term rental. You don't need rep status for short-term rental. Short-term rentals are like a business. You just need to meet something called material participation requirements. So that's another rule. So if you email me, I'm Samuel, I can explain this to you, and we can schedule a call as well. But you don't need rep status for short-term rental. Long-term rental is only that requires a rep status for tax savings. Okay, guys, thank you again. Okay, this has been great. I appreciate every one of you. If you need any help, reach out. Like I said, follow us and we'll do great.
Yes, and
That's
if
good.
anybody's interested in scheduling a call, please visit our website, investorfriendlycpa.com. If you look at the top right-hand corner, it says client intake form. Then that just is a discovery call, intro call with me. So please fill it out and be as detailed as possible. And you can schedule a call with me as soon as you see an availability open on our calendar. And we look forward to talking with you more.
Perfect. This is great. Thank you, Julie, for putting this together. And we'll do more of these if you guys want to join. Probably just discuss the same thing, but we'd love to have you guys. Take care. Bye-bye.
Thank you guys. Bye.